Good afternoon, everyone, and welcome to this month's webinar, Insurance Planning and Kids. Today's presentation will last about 50 minutes. And remember that we love questions, so feel free to ask them on screen throughout the presentation. At the end of the presentation, we'll do our best to open the phone lines, time permitting, for verbal questions as you raise your hand on screen. The webinar is being recorded and will be posted to our website within a week. And regarding CFP-CEs, if you are logged into the webinar today for more than 50 minutes using the email address you registered with, we will report your attendance to the CFP board. That process can take up to about a month. If you were with us February or last month, you learned that our webinar series this year will take us through the lives of one couple, Sam and Sally, through the ages. This month, they're planning for and around kids. Throughout the year, we'll follow them through to the end of their policies, the end of their lives, and the end of the year, December. Today's presenter will walk you through why insurance oftentimes makes sense when children are involved. And now about your presenter. Mark is living proof that sometimes tradition is a good thing. As the son of insurance experts Judith and Keith Maurer, Mark joined Low Load Insurance Services in 2003 and assumed his current role as president and CEO in 2008, with CEO being added January of this year. He earned his CFP designation in 2006 to complement his bachelor's degree in business and finance and his MBA. Early in his career, he managed market operations for an energy trading company and financial operations for an international shipping company. And now I give you Mark Maurer to present Insurance Planning and Kids. And he's an expert at it. He once was a kid, and now he has two.
Hi, everybody. It's Mark. Thank you, Dina. You will find every once in a while that I might ramble a little bit on this presentation because I happen to use that Sam and Sally have a 3- and 5-year-old, which I do too. So sometimes I start with stories, but hopefully that'll make it a little more interesting for everybody. So what we're going to cover today, we're going to talk about insurance that protects kids. Talk about insurance covering kids, and then what I call sometimes insurance to the kids. There's a protection when kids are small. There's life insurance, I'm talking life insurance on kids, and then a transition at some point in life where it's not that we need the life insurance to protect our kids, but it's something I'd like to leave to the kids. And I like to go to this slide. Why life insurance in our 20s, 30s, and 40s? Really, really basic. Life insurance is that if somebody dies, there's money that goes to our beneficiaries. Let's talk about BC. Before children, you may have a very minimal need. And sometimes I talk with advisors for clients who are NINCs, no income, no kids, or SINCs, single income, no kids. Sometimes, really, if you have no kids, nobody that's relying on you, no anyone who's really you're supporting, it sounds kind of bad, but if something happened to you, there's no one who's there, so you may not even need life insurance. Dual income, no kids, or DINKs, my wife and I were that for a while, and if something were to happen to me, she probably would have just moved on to someone better. So, the life insurance, when there wasn't that dependent, can have sort of a minimal need. But once you have children, you need life insurance. There are now very small people who, when we talk about the DINKs, a spouse could get a new job, or they might still be working, dual income. Spouse who's still working. They're buying less food because not there. But when you have children, everyone needs life insurance. We talked about what we're going to cover. Let's talk about insurance protecting kids. Here at Low Load, one of the things we run into frequently is on the application, we ask you or your clients to name the beneficiary of the life insurance policy. Now, what you may think of what you'd like to do and how to do it are generally two very different things. The primary beneficiary, usually it's 100% of the policy would go to your spouse or partner, even if you don't have kids, but I'm talking about people who have kids. The 100% of the death benefit goes to the partner to do all those other things. And a lot of times, people want to name their children as the contingent beneficiaries. It makes sense in one way that if my wife wasn't around, I would want the money to go to my kids. The problem is a 3- and 5-year-old cannot enter into a contract. They cannot take receipt of life insurance proceeds. So really, is this a good idea? Well, here's what I think would happen if my 5-year-old son was able to get half of my life insurance coverage. The Lego store would have a field day. Probably not a good idea. My daughter, fairy and princess, everything. So there's a reason that a 3- and 5-year-old can't take receipt of life insurance proceeds. So how do we prevent a 3-year-old from blowing a death benefit on making her room look like the Tinkerbell movie? Well, 2 pretty basic scenarios. The primary is still the spouse or beneficiary. My wife is still the primary beneficiary of my life insurance policies. My secondary beneficiary, if my spouse wasn't alive, is for the life insurance to pass to the estate created under my will. So the executor, who is going to manage all of that, protects the financial interests of the minor children. Now, when it goes through my estate under my will, it's going to go through probate and have some of these issues. So while this is maybe not the best option, it's definitely better than trying to pay a 3-year-old or 5-year-old hundreds of thousands of dollars, which they can't do. That we know will get caught up somewhere in some court and can take months or however long it might take before anyone can actually help or pay for things with the children. Scenario 2 is maybe a little bit better. A trust is the owner and primary, and it's actually the only beneficiary of the life insurance policy. Now, this can be an irrevocable life insurance trust that we talk about later, or this simply can be a revocable or living trust. In this scenario, the trust is the owner of the policy and the trust is the beneficiary of the policy. We don't need a contingent beneficiary because the trust it doesn't die. So the trust would be the beneficiary of the policy. If I were to die, then the benefits gets paid to the death benefits paid to the trust, and then the trustee protects the financial interest of the minor children. The benefit of that one is it isn't going to go through probate because it's paid directly to the trust. So 2 scenarios, but the end goal is that what we want to do is have the money available to the children. But by naming minor children as beneficiaries, we create a lot of headaches that way. Let's design life insurance around kids. As I touched on, when you have children, you need life insurance. But what you as advisors struggle with every day, you ask us about, your clients ask us about, they ask you about, how much life insurance do I need and how long do I need it? Well, in this situation, any is better than none, but if we want to create a comprehensive life insurance program, I want to talk about a tiered approach to life insurance. So Sam is 32. Based on financial calculators, he needs $2 million today if he were to pass away to provide for his children, his mortgage, his spouse, all those other things. And we determine it's a term need. In 30 years, he will have earned all of his income, been able to pay off his mortgage, save for retirement, get the kids out of the house. And so we determined that the need is a 30-year time frame. Kids are 3 and 5. So we could look at a one policy option for a $2 million 30-year term policy with an annual premium of $1,340 per year. And there's nothing wrong with that. That's a great way to look at the situation and start getting him coverage. But if we determine or can separate out those sort of life events and structure the life insurance contracts a little bit differently, we can do some pretty neat things. So what we determine is that we still need $2 million of life insurance today, but let's layer it with $1 million of 15-year term, $500,000 of 20-year term, and a $500,000 of 30-year term. So for the first 15 years, all three of those policies are in force. So if Sam were to die in the next 15 years, there's $2 million of death benefit to provide for his family. In 15 years, the 3-year-old will be 18, and when I say when you're 18, you're self-sufficient, there's always people who laugh and chuckle, but let's say at age 18, they can join the military, they can vote. So I'm going to say at age 18, they don't need anybody to drive them to school or prepare food for them. So go with me that in 15 years, the insurance need really drops off because the kids can be self-sufficient. But then we still would like to have some more term because after that 15 years, we have college, which as I see every day on the news, it's amazing what that costs. My kids are 3 and 5, so when you inflate some of the numbers for what they are today, it's pretty frightening to me. But we want to have additional coverage that if something were to happen to Sam while college is being funded and paid for, we have that other policy. So we have then $1 million for 5 more years, a total of $2 million for 15 years, $1 million for 5 years after that. And then, of course, like all of us who have kids, we put our kids first, take care of ourselves last. So those last 10 years of Sam's working life is when he's going to do the majority of his retirement funding. And so we need that $500,000 of 30-year term to protect those last 10 years. So we have this sort of tiered ladder, but because we're layering it and not all of the coverage needs to last all 30 years, the annual premium for these 3 policies is $915 a year. That's a 32% savings over the $2 million 30-year term. The theory behind this is that if Sam lives the next 15 years, he will have 15 years of income, and in 15 years will need none of these things happen, so he will have satisfied some of those life goals that he got the kids out of the house, he paid for towards some of the mortgage, towards some of the retirement funding. So that's just an idea that we look at pretty regularly for your clients and you when you ask us ideas about how to design policies for your clients. And now I want to talk about special needs planning. Many times children with special needs, and I'm not a special needs attorney or an expert in special needs planning, that's definitely something you'd want to contact a attorney to set up the specific types of trusts and things. But in the big picture, special needs children may require lifetime additional help. The things that we all take for granted may be very hard for special needs children and may require assistance for the rest of their lives. So my idea that in 15 years they turn 18 and they can fend for themselves may not be a realistic expectation or number for parents with special needs children. Term insurance may help for the early death of one parent, while if my wife and I had a special needs child, if something were to happen to me, there would be term life insurance to provide money for her to keep the house, pay the mortgage, do all those things, and she'd still be able to care for that special needs child. But there are so many things that parents with special needs children do for free because they're your own kids, that if you needed to hire specialists or hire people to do all of those different things, there can be this very large exposure that if neither parent happens to be alive, the magnitude of the need and the expected financial exposure can be huge. And when we talk about this, term is great for next 20 or 30 years, but many times special needs children may need that lifetime of care, may need lifetime assistance, but they might have relatively normal life expectancies. And so the idea of needing term, having term for 20 or 30 years just isn't going to be long enough. The need might be whenever the parents are gone, whenever that might be. Just to put an idea of these numbers, there's almost 750,000 people in the USA under age 21 with autism. And of course that varies on what the severity of the autism is, but those are children, young adults who have normal life expectancies but may not be able to function what we consider by themselves, and may need that assistance or care or help. The parents are able and willing to do for free. Individuals with Down syndrome, the average life expectancy is mid-50s, which is much higher than it was not too long ago. So the idea of a 10 or 15-year term meeting some of these needs or goals may not be realistic either. So what if something happened to mom and dad? The fallback might be, well, the siblings are going to take care of that child. The siblings may have their own families. Did mom and dad ever actually talk to the siblings about that's what the expectation is? They may not be able to, may not want to, may have their own families, and that's not something that they're able to do. Does anybody want the worst case scenario? The government can take care of children if things haven't been properly set up. I don't know anyone who would want that. So let's consider a survivorship or second-to-die life insurance policy to cover that largest exposure. Largest exposure is if mom and dad aren't alive. So a second-to-die policy covers that exactly. Second to die, meaning there's no death benefit until the second of the insured dies, meaning mom and dad. And again, talk to an attorney who specializes in special needs trust when setting all these things up. I just want to talk about ideas on what these needs are from the financial standpoint, and then the legal standpoint, that's an attorney. So Sam and Sally have a special needs child. Sam has $2 million of life insurance in its term to cover his income earning years, and Sally has $1 million of 20-year term, and that's just to provide Sam life insurance if something were to happen to Sally, so that he can continue to work, and he'd need to hire caregivers for Sally or for Susie. And Susie's age 4, and like we said with the term, the client and the advisor consider them quote-unquote covered if something happens to one parent. If something happened to Sam, Sally with the $2 million of term in his income earning years would be okay and be able to care for Susie. Likewise, Sam with the $1 million of life insurance on Sally would be able to provide for that care and still be able to work. But Susie has special needs, will require lifetime assistance, and her life expectancy is not significantly diminished. So what this means is that, remember, Sam and Sally are 44 and 42, and she's only 4. So if Sam and Sally live to their normal life expectancy, mid to late 80s, Susie's only in her mid-40s. So we have a potential for let's say 40 years of care that isn't provided because Sam and Sally are deceased because they lived to late 80s. And so the advisor recommendation was $2.5 million of a second to die guaranteed UL policy. And again, that might seem like a large policy, but again, remember that we have 40 years of care that more than likely they may need to to be able to provide for this child, and that's to be able to provide that when mom and dad are gone. And in things we don't like to think about, but what if the need for the life insurance ends? Most of the guaranteed survivorship policies out there have little to no cash values. If for some reason the child dies prematurely and mom and dad are still alive, may not need the life insurance policies anymore and surrender the policy, but there's little to no cash value. We do have a new low-load survivor guaranteed UL policy that actually builds cash values for this sort of in case, just in case. So let's say, I think this was 30 years out, they have lots of options with this other policy. There are cash values that they could surrender the policy for and take and do whatever they might want with it. They could keep the policy as is, continue to pay the premiums, and change the beneficiary, maybe to the other children. They could reduce the policy to a paid-up policy and not pay any more premiums, have less life insurance, and still use that to leave a legacy to other children or charities. Because this policy has cash values, there's flexibility built into it that others might not. Again, this may be important when there's this possibility that mom and dad will outlive the children. Another thing that comes across my desk pretty regularly is this idea of life insurance and college funding. And many of you have sent me policies, and you might have a client now who own permanent life insurance. And almost always it's commission life insurance policy. They're told it's for college planning. They're told that the cash values in life insurance contracts are not included in the FAFSA calculations, which I think is the federal, I forget exactly what it was, but the federal financial aid calculations, or that it's discounted. That shouldn't be not discounted, it should be, or at least it's discounted. The cash values on a life insurance policy that a parent owns. So it's for college planning. Your client owns this policy, owns the cash values, but those cash values aren't considered an asset for a lot of financial aid calculations. And they're told, well, you have all these options. You can take the money out for college, you can take withdrawals, you can take loans, and even better, if you use it for college or don't need it for college, then you can take it out for retirement. Greatest thing since sliced bread. What I've found many times, though, is that clients are funding these to the detriment of other retirement vehicles or paying off mortgages, things like that. And sometimes the college funding, the trying to qualify for financial aid tail is wagging the overall sound financial planning dog, so to speak. And most of the time it's not set up correctly. Let's talk about the wrong way to do this, and unfortunately this is what usually happens. Commissioned permanent life insurance policies. There are surrender charges if things happen, if the client's need changes. There are surrender charges or penalties to get access to their cash values. I've seen some even that still have surrender charges when they're projected to have kids in college to take the money out, which makes no sense. Starting late. What I mean starting late is trying to put away a lot of money into life insurance policies when kids are starting college in 2 or 3 years. This doesn't work because in order to make it any kind of favorable tax treatment when you take money out, you need to have some sort of ratio of life insurance to cash value. So when you start trying to really cram money into a life insurance policy in 2 or 3 years, many times it ends up creating a really large amount of insurance. You're paying a lot of cost of insurance on the policy. So again, it's this college funding tail wagging the dog, and it doesn't look very competitive. Small premiums. The the whole idea here is to put money away for college. If you're using small premiums on a life insurance policy, you're not accumulating very much, and it just doesn't make much sense. But again, we see that sometimes. The right way, if you do this, talk to us. We can look at options for your client rather than, if this is something they're sold on, rather than the wrong way, we can set it up the right way. With a no load or no surrender charge policy, we can get them to start early so that they can put the money into a smaller life insurance policy to minimize the cost, and we want to overfund it. Again, the idea is to put money away, so we want to pay in as much as possible and still keep the policy life insurance, still keep all of the tax benefits of it. Well, what if Sam and Sally had co-signed school loans? Well, they might want to purchase life insurance coverage on their children. And this one can be a term policy. Hopefully the college loans will be paid back in a number of years. And if they co-sign school loans and children, something will happen to the children and they can't pay back the loans, they may want the life insurance on the child to be able to pay back the loans. Or if they co-sign the school loans, they might be glad to purchase those no-load ULs when the kids are smaller, which is a nice teaser into the next section, which is insurance covering kids. First, I want to talk about the child rider on term policies. And this is a rider that is attached to the parent's term policy. It is usually available in $1,000 increments or units up to either $10,000 or $20,000. Off the top of my head, I would think half of the companies we work with have a $10,000 cap. The other half would go up to $20,000. But the most common is $10,000, and just as a ballpark idea, SBLI's term policy, you can add $10,000 of child rider for $54 per year. It's relatively simple in that it covers all eligible children for the selected amount with one annual premium. So that one $10,000 rider can cover one child or 8 children, $10,000 per child. So obviously someone who has 8 children is getting more of a bang for their buck for that $54, but then again, they do have 8 children, so they can take whatever breaks they want. Choose a handful for me. It includes unborn children, so really what happens is the language is very open. It's just children born of this marriage or whatever it might be, or born of this parent. There's no underwriting for this rider. It's just that if a child was to die while this rider's in effect, there's a scenario $10,000 death benefit paid. Again, remember, it's a rider attached to the parent's term policy, so the coverage will last normally until the child turns 25 or the parent turns 65. Oh, and somebody just asked a question, does it cover adopted children? And yes, it would. I think I just made up language there, but it would cover adopted children. Coverage would last until the child turns 25 or the parent turns 65. At that point, then the rider, you may have multiple children, and if, let's say we have the 8 children, the firstborn turns 25, they essentially roll off of the rider, and then the rider's only covering the younger 7 children. Or when the parent turns 65, the rider ceases, no matter how old the children are. The policy lapses. There's no child rider, which sort of makes sense because it's a rider attached to the term policy. Or the rider is terminated and parents can just surrender it. Most child riders have a conversion option, which says that on any policy anniversary you could convert child A's term rider for $10,000 to a $10,000 universal life policy, whole life policy, whatever it might be. A number of companies have a a bump up, or when the child reaches 25, sort of hits the end of that being a child, quote unquote, on that term rider, they may be able to convert to a multiple of that $10,000. Most often it's 5 times. So that $10,000 when a child's 7, 8, 9, they could convert the $10,000 child rider to a $10,000, call it whole life policy. When the child reaches age 25, then maybe they'll convert that $10,000 child rider to a $50,000 policy. So it's, again, it's a nice idea. Somebody asked, what's the main purpose of having children's rider? It's a small death benefit. I would say for the most part, it's burial insurance. $10,000, I don't know what a funeral costs, and I'm just can't even imagine, but the idea there is that that's what it would cover. But why cover kids? I own life insurance on my 2 children. I also own term, but I don't have the child rider. I have a $100,000 no-load UL on each of my children. They're 3 and 5, like I mentioned. Why do I have that? Well, it could provide for health costs in those situations where there's expensive health issues, and then someone dies. There'd be that death benefit there to help cover some of that. Final expenses, not unlike the term rider, there are final expenses that are due, and that would cover maybe some of that as well. But in a bigger picture, lost income. While I can't imagine that sort of scenario, but something happens to my one child or both kids, I can't imagine the things I'd have to deal with and how hard the grieving process would be, not only for myself but for my wife. So that larger than just a $10,000 policy would cover possibly some of my lost income when I'm not at work for a period of time. The other great things about having it be permanent coverage instead of just a child rider is it protects future insurability. As of right now, my kids, knock on wood, don't have any health issues, but things happen in life, and things do happen, and they will happen. And so as of right now, I was able to get a small life insurance policy on my kids while they're still insurable, and with children's policies, there's very little underwriting done in general. So they have this insurance that's already in place today that is a start in case something happened to them in the future. Again, personally, I don't think it's a term need. Term may not end. Term will end. I think what I meant there was that the need for the insurance may not end, where a term policy does end. And a term policy will always have a fixed death benefit. With a permanent policy, you can also include the guaranteed insurability riders, sometimes called an insured insurability rider. Each company has a different name for it, but what it allows you to do is increase the coverage without underwriting at specified periods. Here's an example. At the policy anniversary date nearest age 25, 28, 31, 34, 37, and 40. So if I had a $50,000 policy, I might be able to increase that policy up to $100,000 or maybe even $200,000, depending on the amount of those increases. There are also alternate option dates available with some companies, and it just depends on the carrier and their language, that if you get married, you may be able to exercise one of those early. Have a child or legal adoption, you can exercise one of those early. And so that's some flexibility built into permanent coverage where term policies don't have that sort of guaranteed insurability rider on them. Universal life is a flexible premium. If you need to skip a premium, you can. You can accelerate the premiums so I don't, there's no cost when the kids are out of the house. And maybe at some point I give it to the children. There's no surrender charges. If something were to happen and I needed access to the cash values, there's no surrender charges or penalties. Will having the life insurance policy help them get dates? Probably not. You know, we try to do everything for our kids. This will do some things, but it can't do everything. So we've talked about protecting kids when they're little, maybe mostly term, to be able to provide for them to eat, things like that. Life insurance on kids to protect their insurability. The third thing I want to talk about is insurance to kids. And this really gets more into legacy planning, where I say maybe the kids are grown, there's assets that we want to leave to the children that aren't easily divisible. So we talk about leaving something to the kids. I want to make sure I leave something to the kids. Life insurance is a great way to leave something to the kids, and many times it works well with other assets. But I wanted to illustrate this with the Brady Bunch syndrome. We have an attorney friend who told us this story, and you can't make these things up. They're just too good in real life. But he was, his client married this woman, and they each had children from a previous marriage. This was the second marriage for both of them. He had 2 children, and she had 1 child. And it was basically when they came into the marriage, he had the money. He had a business that he sold, and so it was he was the one with the net worth. And as they're talking to our attorney friend, they start talking about estate planning, and they said, well, we want to leave everything to our kids equally. Equally can be sort of a ambiguous word, so the attorney asked, well, Mr. Client, what does equally mean to you? He said, well, you know, I think of her daughter just like my daughter, so I think, you know, everything should go to them equally, a third, and a third. And the wife said, well, I think equally too, but equally means half to my daughter and half to your 2 children. We have some ambiguity here on what equals means. And if anyone can guess how this turned out, they ended up getting the divorce. The attorney said, I see we have a problem here. I don't think I can represent both of you. And less than a year later, they were divorced. So, point of this story is that especially with second marriages, when there's assets that people think will go to this person or that person, life insurance is a great way to pass assets. You can specify a beneficiary. You can specify an amount. Had they had a financial advisor like you all, they may not have gotten into that situation because they may have already had some life insurance that went to one of these children or both or all 3, something that would have prevented all this from happening. But I want to leave something to my kids. We're talking about leaving a legacy. It probably isn't any surprise since my mom and dad are in the insurance arena that it's something that I have for my kids, but it goes back to my grandmother had life insurance on herself, and she wanted to leave it to my father and his 2 sisters. It was a pretty small policy, but the idea, she wanted to make sure she left something to her kids. And I think a lot of people, when it comes down to it, want to do that. Sometimes it just depends on how much and what does it cost. But a lot of us who have kids want to leave something to our kids. And my grandmother wanted to leave it to my dad, his 2 sisters. My parents want to leave something to my brother and myself. I want to leave something to my son and daughter. So Is this a protection? Is this something we have to have? No. But is it something that makes a lot of things easier? Absolutely. Here's a situation, and my Uncle John and Aunt Karen, they have been frugal, they've invested carefully, and at one point their advisors told them, look, you've done such a good job with all this, you need to start spending your money because you really have all this and you're really not doing anything with it. Their fear was that they didn't want to have nothing and not leave something to my two cousins. So what they wanted to do was have this plan where they still were able to leave a legacy and still start spending the money to do things that they wanted to do, like some traveling. They wanted to work on some of their hobbies. And my cousins had businesses that they were starting to get off the ground and wanted to be able to be investors in those. So like they say in Top Gun, they were holding on too tight. They didn't want to use up any of their own money because they wanted to make sure that they left something to their kids. So we talk about creating a floor. That's exactly what this does. And again, I come back to a second to die life insurance policy. It's to make sure that they leave something to their kids whenever they die. We're replacing assets spent during lifetime. And Karen and John, it was a $400,000 second to die policy. So each of my cousins was going to get $200,000. They paid in $8,555 premium for 14 years, and it guaranteed it for their lifetimes. So out of their total portfolio and net worth, they take this little part off to make sure that there's this floor of $200,000 that goes to each of my cousins, and now they can use the rest of their assets to do all those things that they wanted to do, because we helped satisfy that need for them was, I want to leave something to my kids. Now when we talk about who should own the policy, so we have an idea of when it makes sense, ideas to create that floor or leave that legacy, but who should own this policy? Many of you may automatically think of an irrevocable life insurance trust. And those are great. They, for the most part, the premiums are gifted into the trust, many times using the annual gift exemption. The death benefit of the policy is removed from the client's taxable estate, and the ILIT and the trustee of the ILIT can protect kids from inability, disability, creditors, and predators. I just like the way that sounds, but the inability to manage money. Usually with an ILIT, we're talking larger policies. Wouldn't be the first time that someone has children who wouldn't be able to handle an influx of $500,000 or $1 million. So the trustee of an ILIT can manage the money for those kids. Creditors and predators. So remember, the ILIT is a separate entity. So if you have children who creditors are coming after them, they can't attach to the ILIT. If they end up getting a divorce, or sometimes parents just really don't like spouses and can already see the writing on the wall where the kids can't. An ILIT is a great way to set that up, because the idea of the spouse, it's a separate entity. The son or daughter doesn't actually own the policy. The second option, and sometimes they call it the poor person's ILIT, is having the kids own the policy. If we have an ILIT own the policy or the kids own the policy directly, the death benefit is still removed from mom and dad's taxable estate. Mom and dad don't own the policy. You make the annual gift either to the ILIT, to the trustee who pays the premiums, or you make the annual gift directly to the kids and they pay the annual premiums. It has some pluses and minuses. Kids have to be at age of majority. They have to be able to enter into contracts. They have to be just kids who are responsible enough to do all of that. you have to be okay that the kids may change the beneficiary. They may surrender the policy. You don't have to give them any more money for it, but it is just an asset of the children. May be included in a divorce settlement if things like that happen. So pluses and minuses to both. Having kids own the policy is free. ILIC requires an attorney to set it up. With the no crummy letters or anything associated with having the kids own the policy. And ILIT, you have to send out the crummy letters for the annual premiums every year. So pluses and minuses to both. To me, it really just depends on the kids and their situation. So somebody asked me, what's your view about putting large term policies in ILITs? When we talk about most of the time for term, I still think we're talking about income replacement, so younger clients. To me, if today, let's say husband and wife have $1 million of assets and a $1 million term policy each, under current estate tax regime, there's no estate tax. If we have a situation where if let's say mom and dad were to die, or maybe just dad, that then we're going to have an estate tax issue, then I think having the ILITs on the term policies makes sense. So the question was about putting large term policies in ILITs. Yes, if at the point in time where there's a death and going under the unlimited marital transfer. So really, if mom and dad both died, the life insurance policies plus all other assets create a taxable estate, then I think an ILIT can make sense. Now, we'll fast forward a little ways. We were talking about early on when clients are in their 20s and 30s and protecting kids. But we've jumped ahead to, they already had their kids, and now they've grown up a little bit. And Sam is now deceased. And Sally has, she has a pension and Social Security income. So she's living pretty well on sort of that income flow. And she has a few assets, an annuity, some checking, money in checking account, savings account, and IRA. But her largest asset by far is the house. And she has son, daughter. In going through the estate plan, she would really like her daughter, who's 51, to have the house. And so what she's done is that daughter 51 gets the house, and then mom's will distributes all the remaining assets equally. Now, I don't know if you have your financial calculators out, but what that means is that the daughter who lives with mom gets a disproportionate amount of Sally's assets. And while that may be okay, that can cause some bad blood between the kids. Mom may not even realize that. So just what are things we can do, and life insurance can help equalize it. Even if we reallocate the will that the daughter gets the house and the kids get half of the remaining assets, that's okay. The kids are still short on their share comparatively to daughter 51, and they may be okay with that. But now we've created a problem where the younger daughter has a house but no cash. So she's house rich, cash poor. There might be a mortgage. There's some other things. But so the daughter who's 51 has a house but nothing to help keep it up. So what we looked at was taking in some of these assets and getting a single premium for $257,000 life insurance policy and making son and daughter the 50% beneficiaries of the life insurance policy. So what we do here is reorganize the assets, use some of the assets that she wasn't living on, wasn't going to need, and creating a larger death benefit for the two children who aren't going to get the house, and still allowing the 51-year-old daughter to have some some cash assets as well, even though she's going to get the house. It's not necessarily a perfect situation. We didn't get everybody an equal amount of assets, but the daughter is 51. The older two siblings might be okay. If the daughter 51 is taking care of mom or some of that, they may be happy to have it work out this way. But I think just part of it is some of the conversation and looking at some of that. Preserving a family business. I know a number of you who have clients, their number one asset is their small business. So let's take a situation where they have this business and Sam and Sally's daughter is going to be the successor owner and manager, and they want her to inherit the business. But the other kids are not involved in the business, and mom and dad want the inheritance to be fair. They could leave the business a third, and a third. The situation, there's 3 kids. But then the daughter who's running everything actually has a minority share. The other 2 could essentially take control of the company, which we're sure is not what Sam and Sally really wanted to do. So again, a solution using life insurance to equalize the children. They leave the business to the daughter, and Sam and Sally buy $1 million survivorship policies for each of the kids. In my situation, we make the kids the owners, and mom and dad can even gift a single premium to them this year, use up some of their lifetime gift exemption, but hey, their net worth isn't over $10 million today, so that might be just fine. But just the idea of leaving everything equally may be what we want to do in spirit, but actually leaving each asset equally may be a nightmare. And so what we've talked about, we've talked about protecting kids, covering kids, and wanting to leave something to the kids. Talked about naming beneficiaries, child riders, term layering, lots of different things that when you have clients with children or even you as advisors with children, start to think of some of these things. It's some nuances of different things that can make a big difference. And so for those of you who haven't worked with us much or are new to us, there's a number of things that makes low-load insurance services different than the local agent or the online web quote service. We do these free monthly webinars every month. Next month in May, Kathy will be doing one on clients in their 30s, so about the same time frame. They may have young children. They're starting to get their financial house in order and starting to work on building up that nest egg. And then we go all the way through December. And so just lots of different monthly webinars for family advisors, and you get the CFP-CEs as well. We're not your competition. We work only for and with the only financial advisors. Your clients are your clients, and we work really hard to protect that relationship. We save you time with our policy reviews and being a one-stop shop for life, disability, long-term care, annuities, and sometimes just questions. And happy to do all those every day. Save your clients money with a lot of pre-underwriting, and we do that pre-underwriting to avoid surprises too. We're proud sponsors of a number of different family financial planning groups. This year, our newest exciting thing is being a sponsor of the NAFID Genesis, which is a group of young planners who are working in the family financial planning field, and we think it's a great organization and a great way to get to meet new people. We have product specialists in those things I mentioned. We keep your clients and you in the loop with our application information message. And even in the future, we let your clients know that they have premiums that are due with our advanced premium email, or APE. I just love that picture. And the last thing is, did you know that last week we just posted a new news you can use with the latest long-term insurance company who's making big changes. Genworth was the first one, and you have to go to our website to find out who's the next. It's on llis.com and right on the left-hand side. And Jerry Skapiak and I will be at the NAPFA Spring Conference in a couple of weeks. May sure seemed like a long ways off, but it's coming up here in the corner, around the corner. So I hope that any of you all who will be there will sit in on my presentation about insurance and the new normal. And if you're a NAPFA Genesis member, we definitely look forward to seeing you at our social Wednesday night in Las Vegas. So thank you all for attending. If there are any questions, raise your hand. And if I didn't get to your questions that you submitted online, I will get to those in the next day or two. And I see no hands, no questions, so thank you all for attending, and we will see you next week, or next month for Kathy Kopak's presentation on disability. Thank you.